Imagine being right there on the cusp of a major breakthrough, something that could power, the next generation of your phone, your watch, maybe even your car.
Yeah, it's that exciting frontier, isn't it? Battery technology. Everyone's racing for more power, smaller packages, faster charging, longer life.
Exactly. And that's the world Enovix Corporation is trying to shape. Welcome to the deep dive.
So you've brought us this fascinating stack of material market analysis, financial reports, technical deep dives, all focused on Enovix.
Right. And our mission today is to really plunge into these sources, pull out the most critical stuff, the surprising nuggets, and help you understand, well, what's the likelihood Enovix actually lands a major commercial deal by the end of 2025?
And what that might mean for them going forward. How do we even think about their value based purely on this data you've shared?
Let's cut through the noise, get to the core of what your sources reveal. Okay, so let's unpack this. Enovix's big claim to fame, what sets them apart, it seems to boil down to two main things. A unique 3D cell architecture. And this is the interesting part. Using a 100% active silicon anode. That sounds pretty different from standard batteries, right?
It really is, and that combination is key based on your sources. Most lithium-ion batteries today, they use graphite for the anode.
Right, graphite.
Some competitors are starting to mix in silicon, sure, but it's often like a composite or much lower percentages.
Yeah.
Enovix is going for the whole hog, 100% active silicon built into this novel 3D structure they've designed.
And if they pull it off, if 100% silicon actually works reliably, what's the big payoff? What's the promise?
The main thing they're asserting, according to these reports, is significantly higher energy density, ED.
More juice in the same box.
Exactly. Think of it like packing way more power into the same size or weight. And your material indicates their own internal tests suggest this advantage only gets bigger with their future tech, the EX1M, EX2M nodes.
Okay.
Plus, it's not just density. They're also claiming, better cycle life, more charges and discharges before it degrades, and faster charging.
And there was something specific in the sources about that.
Yeah, a key detail was that sample cells they sent to a major smartphone OEM. They reportedly met the custom specs for exactly those things. Performance points.
Meeting custom specs. That sounds like a pretty big hurdle cleared.
It's a critical validation step, absolutely.
Okay, here's where my head starts spinning a bit. Silicon. It should be amazing for energy density, right? Holds almost, 10 times the energy of graphite?
Theoretically, yes. Huge potential.
But the massive elephant in the room is that it expands like crazy when you charge it, like up to 300%.
That's the fundamental silicon challenge. You're spot on. The expansion is just dramatic.
So how does this 3D architecture supposedly handle that kind of swelling?
Well, that's the million-dollar question, isn't it? The swelling, it causes immense stress, cracking, loss of contact, kills performance fast.
Right.
Enovix's 3D architecture is specifically designed, they say, to create internal space and structure to manage that huge volume change. If they've truly engineered a way to accommodate that 300% expansion reliably with 100% silicon at scale, that's not just an incremental improvement, it's potentially a major breakthrough.
And if not?
If not, as the sources sort of imply, could be a risk, then yeah, real-world durability, long-term performance, that remains a crucial question mark.
They also talk about being materials agnostic.
Right.
What's that about? Is it a backup plan?
What the material suggests is they believe their core 3D design isn't permanently locked into only using 100% silicon.
Okay.
They claim it could potentially integrate other advanced anode materials or even cathode materials as they mature down the line.
So flexibility for the future.
Could be. Offers flexibility, maybe helps manage supply chains. You could frame it as smart long-term strategy. Or you could perhaps infer it's a nod to the fact that relying only on 100% silicon might have some long-term challenges they need alternatives for.
And they're definitely not alone in this race. The competition sounds fierce.
Oh, absolutely not. It's intense. Your sources rattle off several names. Sila Nanotechnologies, Group 14, Amprius, StoreDot, QuantumScape, others too.
And some of those guys already have deals.
That's a critical insight here. Many of these competitors have already announced significant deals with big OEMs like, phone makers, car companies, or they're actively scaling up their production.
So cool tech isn't enough.
Exactly. It highlights that innovation is just step one. Translating it into reliable, large-scale manufacturing and actually landing those big customer contracts, That's paramount.
And some competitors offer easier integrations, drop-in solutions.
Yeah, some are promoting solutions that might require fewer changes to an OEM's existing manufacturing lines. That could be an easier sell than asking them to potentially retool for Enovix's unique architecture.
Unless the performance jump is just so big, it's worth the hassle.
Precisely. The benefit has to clearly outweigh the integration effort.
Okay, so they have this potentially game-changing tech, but can they actually build it consistently, at scale? Let's shift to manufacturing and customer traction. This Fab 2 factory in Malaysia sounds absolutely critical.
It really is. That's their designated high-volume manufacturing, or HVM hub. And your sources point to two really crucial recent milestones there that significantly de-risk things for potential partners.
Okay, what are they?
First, late in 2024, they completed Site Acceptance Testing, SAT, for the main HVM line.
SAT, meaning?
It means the equipment's physically installed in Malaysia, it's been tested on site, and it's basically ready to start making batteries. It's not just theoretical anymore.
Got it. That's big. And the second?
Second, in Q1 of this year, 2025, they achieved ISO 9001.20 and 15 certification, and importantly, with no major findings.
ISO 9001.
Yeah.
That's the quality standard, right? Like table stakes for dealing with big companies.
Absolutely essential. It's a global quality management standard. OEMs basically won't even talk to you seriously without it. They also had their first direct customer audits of Fab 2 in Q1. Another key validation step, kicking the tires.
So the factory is getting ready, passing the necessary checks.
Exactly. And the target is mass production by Q4 2025. Aimed initially at smartphone and IoT customers.
And they also did something in South Korea. Wasn't just Fab 2.
Yes, that's right. Earlier this year, Q1, they acquired assets there from SolarEdge. Your material points out this wasn't just about adding generic capacity.
Okay.
It included specific coating equipment, which actually supports the planned expansion at Fab 2 later. And it also added production capacity that's already being used for existing defense programs they have in South Korea.
So it helps now and later.
Right. Plus, that facility is also where they're assembling battery packs for XR extended reality products using the cells made in Fab 2. They actually shipped the first samples from Korea to smart eyewear customers recently.
Wow. Okay, so it seems like proactive planning supports current revenue, too.
It shows they're thinking ahead, yeah. Supports defense revenue, builds manufacturing expertise, and positions them for wearables.
Okay, let's get to the deals. Where are the most concrete signs? Let's break down customer engagement. Smartphones first. That seems like the big prize, near term.
Definitely their primary focus for 2025, commercially speaking. Your sources state they're engaged with 7 out of the top 8 global smartphone OEMs.
7 out of 8. That's deep engagement.
It is. And a critical step mentioned, starting in Q2 2025, just now, they began qualification deliveries.
Meaning actual batteries.
Actual battery cells, yeah. Built to match the size and specs needed for a specific planned product, and according to the reports, they're still on track for a customer to actually launch a product using their batteries later in 2025.
A launch this year. Wow.
That level of engagement, moving from talks to qual samples to a planned launch window, is a pretty strong signal of serious interest.
What about IoT and wearables? You mentioned smart eyewear. I saw something about a prepaid order.
Yes, that segment shows some really tangible early wins. Your material highlighted what it called a landmark prepaid purchase order.
Prepaid, like cash up front.
Seems like it. From a global technology leader in AI and immersive tech for their next-gen smart eyewear. And here's a key detail. The order didn't just secure product, it also included reserved production capacity at Fab 2.
So they're paying to hold their spot in line.
Exactly. It shows significant confidence. They're also working with a Fortune 200 company on a fast-growing IoT product, and commercial shipments for these IoT products are actually scheduled to start now, mid-2025.
So IoT is happening sooner than smartphones.
Seems that way, yeah. Mid-year shipments starting. Prepaid orders, reserved capacity, these are strong early validation points from partners.
Okay, EVs, the huge potential market. Where does Enovix fit in there right now?
The reports show development agreements with 2 large automotive OEMs, and they hit some key milestones with one of them in Q1 2025.
Milestones that do what?
According to your sources, these milestones increase the likelihood of expanding that relationship into a commercial agreement later in 2025.
A commercial deal in EV this year.
Potentially, but need to manage expectations. Enovix calls their strategy here capital efficient, which likely means focusing on targeted development, maybe using partner money for bigger EV lines rather than building massive EV fabs themselves right now.
And those auto timelines are long, right?
Notoriously long. Your sources mention a typical 4 to 7 year qualification process for cars.
Wow. Years.
Yeah. So while a deal by end 2025 is possible, it's much more likely to be, say, an expanded development agreement, maybe a joint testing program, or perhaps supplying a niche EV application first, not batteries for a mass market flagship car just yet.
Got it. And defense. Just steady revenue.
Exactly. Provides early foundational revenue. It also serves as demanding use case, helps validate the tech's robustness. They have bookings supporting growth there into the second half of 2025, and that South Korea acquisition helped add capacity for those programs. Solid base while they chase the bigger consumer fish.
So if you connect the dots, manufacturing getting ready, deep customer engagement, what does this convergence tell us about a deal happening by year end?
This convergence is really the key takeaway here. You've got a certified factory nearing mass production capability, SAT done, ISO secured, customer audits happening. And you combine that with this deep, tangible engagement across multiple segments, especially the concrete steps like qual deliveries and planned launches with major smartphone and IoT players.
It makes them look much more real.
Exactly. It makes Enovix a far more credible and ready partner than they were, say, even a year ago. And crucially, this timeline aligns pretty well with the typical product development cycles for consumer electronics, aiming for launches around late 2025 or early 2026.
Okay, let's switch gears. The financials, this kind of cutting-edge R&D and factory build-out, it costs a fortune, right? The numbers must reflect that.
Precisely. What your sources paint is, well, it's the classic profile of a deep tech growth company at this stage. Heavy investment is the name of the game, not current profit.
So what did the recent revenue look like? Q1
2025 revenue came in at $5.1 million. Your material notes this actually beat their guidance, which is good.
Okay.
But it was down from $9.7 million in Q4 2024. That was largely attributed to, seasonality in the defense business. Their guidance for Q2 2025 is in the range of $4.5 million to $6.5 million.
And the full year, what are analysts expecting?
Analyst consensus for full year 2025 revenue is pegged at $36.9 million. Now, here's where you see the story in the numbers. This forecast implies a pretty significant 61% jump in revenue year over year. If you just add up Q1 actual and the midpoint of Q2 guidance, you get around $10.6 million for the first half.
Right.
To hit that $36.9 million full-year target, they need to pull in roughly $26.3 million in revenue in the second half of the year.
H2. Wow, that's a big ramp from H1.
Huge ramp. Yeah. And that forecast is entirely hanging on them successfully starting mass production in Q4 and securing those commercial shipments fast.
Which naturally means high costs and losses right now while they build up.
Exactly. They're pouring money into R&D and scaling manufacturing. Your material shows their GAAP operating expenses.
GAAP being the standard accounting rules.
Right. Generally accepted accounting principles. Those were $42.8 million in Q1 alone. They reported an adjusted EBITDA loss of $22.2 million in Q1.
EBITDA, earnings before interest, taxes, depreciation, amortization. Adjusted means taking out some one-off stuff.
Basically, yeah. A measure of operating cash flow, roughly. And they're guiding for continued losses in Q2. Their net margin profit after all expenses is, deeply negative, over minus 385%.
Yikes.
Reflects the huge spending versus current revenue. Standard for this kind of build-out phase, but it means they're burning through cash.
Which leads to the big question. Cash position. Runway. Do they have enough fuel in the tank to get to mass production?
Okay, so they ended Q1 2025 with $248.2 million in cash and marketable securities. Your sources did a calculation. Their cash burn in Q1, combining operations and capital spending, like on equipment, was about $23.2 million.
So at that rate, how long does the cash last?
At that specific burn rate, simple math gives you roughly 10 to 11 quarters. So about 2.5 years of runway.
Okay, that sounds decent.
And this is a really key point in the analysis, that runway could shrink, potentially significantly. If capital spending needs to ramp up sharply for Fab 2, or to build new lines for a big customer, unless a partner steps in with funding, that could be upfront payments, milestone payments tied to progress, maybe even direct investment in the production lines, that could change the cash picture dramatically.
What about market cap? How's the market valuing them now? And debt?
Market cap total stock value is around $1.47 billion as of May 2025 when this material was compiled. Debt-to-equity ratio was reported at 0.78. One source flagged this as higher than the industry average, but another source noted they have minimal traditional debt, suggesting maybe that ratio includes things like warrants, which are common financing tools for growth companies. They don't pay dividends, of course.
So wrapping up the financials,
Yeah.
what's the takeaway for someone looking at this?
The financial picture is, frankly, entirely typical for a pre-commercial deep tech company that's all in on scaling. The absolute critical financial question highlighted by your sources is that $248 million cash buffer enough to bridge them successfully to mass production and get them to positive cash flow driven by a major deal?
And that H2 revenue forecast really underscores how much depends on hitting that Q4 production target and getting paid for shipments.
It really does. Everything hinges on that successful ramp.
Okay, let's pull it all together. This is the crust of it, the big question your sources were tackling. Will Enovix actually land a significant commercial deal by the end of 2025? Based on everything you've seen in this material, what's the assessment?
Okay, based on the analysis, the specific progress outline, all the details in your sources, the estimated probability of Enovix securing a significant commercial agreement, maybe a partnership or a supply contract, by the end of 2025, it's assessed as moderately high.
Moderately high. Can you put a number on that?
The estimate derived from the sources lands in the range of 65% to 75%.
65 to 75%. Okay,
Yeah.
Definitely not a slam dunk, but solid odds. What's driving that optimism? What are the key factors pointing towards a deal actually happening?
There are several strong drivers, all pulled from the concrete steps detailed in your material. First off, manufacturing readiness. Fab 2 hitting SAT, getting ISO certified, having that clear Q4 production target. It makes them a plausible, high-volume supplier within the time frame needed for product launches next year.
So the factories look incredible. What else?
The depth of that OEM engagement we talked about. Engaging with 7 of the top 8 smartphone players, that's not just kicking tires. The fact that qualification delivery started in Q2, and there's a planned product launch later this year using their batteries, that shows they are deep in the development cycle with potentially huge customers.
It's moved beyond just talk.
Right. It's moved into validation testing for actual products, and then there's the early traction.
Those IoT wins.
Exactly. There are real, tangible signs of interest beyond just evaluation. That prepaid PO for smart eyewear from a global leader, the Fortune 200 IoT collaboration with shipments starting now, these are actual customer commitments validating the tech and their early production capability.
Okay. And the overall market?
The market clearly wants what Enovix is selling or trying to sell.
Right.
There's huge underlying demand for better batteries, higher density, faster charging across EVs, consumer gadgets, defense. And the fact that competitors are landing major deals shows that OEMs are actively locking down supply of next-gen tech now. It's a competitive scramble.
Okay, so with all that momentum,
Yeah.
why isn't the probability higher? Why not 80, 90%? What are the big risks holding it back?
The main reason it's not higher really boils down to execution risks.
Yes, especially
Manufacturer.
Can they actually do it?
Yeah.
Can they really ramp Fab 2 smoothly? From initial batches to consistent high-volume mass production starting in Q4, with good quality, good yield, hitting cost targets. Scaling complex manufacturing, especially with novel tech, is notoriously hard. Unforeseen problems pop up. Makes sense. Building it is one thing. Running it efficiently at scale is the real beast.
Precisely. Another risk is just the nature of OEM qualification. Even when things look good, these processes are incredibly strict. Delays can happen for all sorts of reasons, some outside Enovix's control.
Bureaucracy, testing issues.
Anything. And finally, that competitive intensity we keep mentioning, it's real. Other strong players are fighting for the exact same contracts.
Your material mentioned a deal readiness scorecard. Table 2. What did that show visually?
Yeah, it basically reinforces this assessment. It rated Enovix as high for tech maturity and high for their engagement in smartphones and IoT. Clear strength.
Yep.
Fab 2 readiness and their competitive positioning were medium-high. Acknowledges the progress, but also the execution challenge and the competition. EV engagement and their financial capacity for massive independent scale-up were rated medium.
So it really points towards consumer electronics for a near-term deal.
Very clearly. Smartphones, IoT, wearables. That's where the near-term probability lies for a deal by end 2025.
And that ties back to the deal cycles you mentioned. Automotive versus consumer electronics. Huge difference.
Immense difference. Automotive qualification, like your sources say, 4 to 7 years. From samples to production cars, it's a marathon.
So an EV deal by year end.
Right.
Probably not for a main model.
Highly likely it would be an expanded development deal, joint testing, maybe a niche application first, not supplying a high-volume car model yet.
But consumer electronics, much faster.
Way faster. Smartphones, wearables, prototyping in days or weeks, tooling in maybe 14, 16 weeks. That short cycle time strongly supports the idea that if a major deal gets announced by end 2025, it's almost certainly going to be in CE smartphones or wearable IoT, lines up perfectly with their Focus and Fab 2 timelines.
So qualification is the gatekeeper, passing all the OEM tests.
It is. It's extensive, rigorous testing. Performance, safety, reliability, consistency, under all sorts of conditions. Your sources mentioned the IRA rules for EVs.
Inflation Reduction Act, domestic supply chains.
Right. While those rules are more complex for EVs, they illustrate the kind of stringent requirements battery suppliers face. Even if the immediate CE focus is outside the US, the qualification hurdles are still huge.
And the deals themselves can be structured in different ways, not just a simple purchase order.
Oh, absolutely. The reports indicate a variety of structures. Milestone payments as Enovix hits targets. Capacity reservations like that smart eyewear deal where the customer pays to secure production space. Long-term volume commitments. Even tech licensing or joint ventures, JVs, where companies partner up on manufacturing or development.
Any examples from competitors?
Yeah, your material pointed to QuantumScape getting a $130 million prepaid royalty from VW's PowerCo just for licensing and industrialization support. StoreDot has a manufacturing partnership and license deal with EVE Energy, the specific structure of whatever deal Enovix lands that'll hugely impact their finances, operations, and capital needs.
And seeing those competitor deals, Sila, Group 14, StoreDot, it reinforces that the market's moving fast.
Totally reinforces it. Sila with Mercedes and Panasonic, Group 14 with Custom Cells, BASF, StoreDot with EVE, Polestar, QuantumScape, VW. These are real deals happening now. It underlines that competitive race among OEMs and battery firms to lock down next-gen tech. Urgency.
And the underlying demand is there. EVs growing, phones needing better batteries, wearables, defense.
Yes, that provides a really strong receptive backdrop. Your sources cite robust demand figures, EV sales climbing, estimated 25% growth in 24, EV battery market itself growing at nearly 13% CGR through 2034.
Wow.
Consumer electronics demand, 9-12% CGR projected to 2030. Flexible batteries for wearables, even faster, almost 25% CGR forecast. Defense spending high, focused on tech needing advanced power. These growing markets create a powerful pull for the kind of performance Enovix is aiming for.
Okay, let's game this out. Let's imagine a deal does happen by year-end, like the sources suggest is moderately likely. What does life look like for Enovix after that? How does it change the game?
It would be, well, a watershed moment, truly transformative for the company.
Financially, what's the impact?
You'd expect a very steep revenue ramp, probably starting late 2025 if they hit that Q4 production target, or definitely accelerating through 2026. Your sources provide some context. The smartphone battery market alone, over $10 billion a year.
Just smartphones.
Yeah. And think about this. A single popular smartphone model might ship 15 million units annually. If Enovix gets, say, $10 per battery, the ASP, average selling price.
Okay.
That's potentially $150 million a year in revenue from one customer's single product. If they get broader adoption, multiple products, multiple customers, it scales dramatically.
What about margins? They're way underwater now.
Right now, very low or negative due to all the R&D and build-out costs, but their target at scale is 25-40% gross margins, which is pretty typical for specialized components.
And they get there how? Volume, yields.
Both. Margins should improve significantly as manufacturing yields get better, meaning fewer defects, more usable product per run, and as volume increases. Consumer electronics is price-sensitive, though, but maybe their advanced tech can command a bit of a premium, at least initially.
And the path to actually making money. Profitability.
It requires getting to that significant revenue scale and having those healthy margins. Operating leverage should kick in. That's where revenue grows faster than fixed costs, like a lot of the R&D base. A major deal is the clearest, most direct route past the current losses towards sustainable profit.
What about cash? CapEx. Does a big deal mean more spending?
It could, yeah. A really big deal, or one needing custom lines, might require more capital investment in manufacturing capacity. However, cash flow from operations should flip positive once they start shipping volume and getting paid.
And partner funding could help.
Could help massively. Like we talked about NRE payments for custom work, prepayments, joint investment in capacity that could significantly reduce Enovix's own capital burden. The type of deal matters a lot here too. Big smartphone contract versus maybe a smaller, higher margin niche deal, different financial paths.
Beyond the money, what does landing a big name do for their reputation, their standing?
Oh, it's huge validation. Securing a deal with a marquee customer, a top-tier smartphone brand, a leader in XR, a major automaker, it's powerful third-party proof. Proof that their tech works and that their manufacturing is viable at scale.
Reduces risk perception.
Dramatically. For every other potential customer looking at them, it also tends to really boost analyst coverage, media buzz, overall brand value, credibility. That first big customer win is a crucial reference point.
And could it speed things up for them, their overall strategy?
Absolutely. Partnering with a major OEM gives them almost instant access to global distribution, sales networks, marketing muscle, stuff that would take them years and tons of money to build themselves.
Lets them focus on the batteries.
Right. Focus resources on the core tech and perfecting manufacturing. It's a potential fast track to wider market penetration.
Strategically, does it open other doors?
Yeah, often creates a domino effect. Makes it much easier to win the next customer. Higher volumes give them better negotiating power with their own suppliers. Helps attract top engineering talent. And it could definitely lead to deeper strategic alliances, JVs, or even make Enovix an attractive acquisition target for a bigger fish wanting that tech.
Like we see with car companies buying battery tech.
Exactly. And operationally, partnering forces maturity fast. They'll need rock-solid quality control, maybe systems like Six Sigma or the automotive standard IATF 16949. Sophisticated supply chain management, it turns them into a serious industrial player.
Okay, let's tackle valuation. Where does the market see them now, and how might a big deal change that perception of value?
Right now, as we said, market cap around $1.47 billion. Valuation metrics based on current revenue, like price to sales, over 60 times trailing 12 months revenue.
Which sounds crazy high.
It's heavily skewed because current revenue is tiny. It tells you the market is absolutely valuing future potential, not today's performance. Your sources mention analyst price targets average around $18.25, $18.50 a share. But the range is huge, like $9 up to 36 cents.
That wide range says a lot, too.
It screams uncertainty, but also reflects that potential for massive upside if they execute and land those deals. The market's clearly betting on that future promise right now.
So, post-deal, if one happens, how should someone think about valuation then, based on these sources?
Gotta look forward. If a major deal translates into substantial profitable revenue, the market will definitely re-rate the stock. The sources suggest thinking about it using a forward enterprise value to revenue multiple.
EV to revenue, okay.
EV being market cap plus debt minus cash total company value. Applying a multiple, maybe in the range of 5x to 15x forward revenue. That's one way the market might assess them. Benchmarking against other high-growth companies, specialized battery tech plays.
Can you run some illustrative numbers based on the potential revenues we talked about?
Okay, purely for illustration, based on the scales mentioned in your material, let's see a base case. One big smartphone deal ramps well, gets them to maybe $200 million revenue 3 years out. Apply a conservative 5x to maybe 10x forward EV revenue. That implies an enterprise value somewhere between $1 billion and $2 billion.
Okay. And an upside case. Multiple deals.
Right. Upside case, maybe they land multiple deals, ramp faster, hit, say, $400 million revenue in 3 years, use a potentially higher multiple, maybe 7x to 15x, reflecting that success, implies an EV range from maybe $2.8 billion up to $6.0 billion.
So comparing those ranges to the current $1.47 billion market cap, significant upside is definitely possible if they nail the execution of the deals.
That's where the potential value creation lies, yes, but the specific terms of the deal, the financial impact, absolutely critical. The partner's brand name adds value too. And, strategic M&A is always a possibility. A big player could pay a premium to just buy them outright.
How do they compare to peers like Amprius you mentioned?
Yeah, Amprius, AMPX, is a relevant public peer, also doing advanced silicon anodes, but with a different approach, nanowires. Your sources note Amprius has a smaller market cap, around $316 million, maybe a lower TTM price sales, but it has a bit more established early revenue from niche areas like aviation. Broader battery indices aren't great comps, too many big diversified companies. Reports on energy storage valuations show a massive range, but truly cutting-edge tech can command those premium multiples.
So pure play silicon anode guys get a premium, but are volatile.
Exactly. Premium if the market believes they're disruptive, but volatile because so much rides on that specific tech working at scale.
What about actual deals in the space? Precedent transactions. What are investors paying?
Yeah, looking at funding rounds gives context. 24M raising funds at a $1.3 billion valuation. Sila's $375 million Series G. QuantumScape's $130 million prepaid royalty from VW. It shows there's significant appetite both from VCs and strategic players for next-gen battery tech. And strategics often pay premiums. Traditional M&A multiples for mature chemical companies, probably way too low for a high-growth, disruptive tech story like this.
Okay, let's synthesize this risk-reward picture directly for you, the listener.
All right. The potential upside, as we've laid out: transformative revenue, big market share gains, critical tech validation from a major customer, enabling follow-on deals, maybe even M&A down the road. Big potential.
But the downside?
Also significant. Risk of not landing a major deal. Risk of manufacturing execution failure, can't scale, yields are bad, costs seem high. Risk of failing tough OEM qualifications. Risk that competitors just win the key contracts. Risk they run out of cash if spending stays high without enough revenue or funding. Risk that market sentiment just turns against growth stocks. Lots of hurdles.
Sounds very binary. There are huge success or major problems.
To a large extent, yes. It's that classic asymmetric risk-reward profile you see in deep tech at this crucial stage. Success could mean massive value creation. Failure, especially missing key execution milestones, could mean significant downside given the current cash burn and development stage.
So, navigating your position based only on the information in these sources. Hold. Buy more. Sell some.
Okay, based purely on these sources. Given that moderately high probability estimate, 65-75%, the concrete progress highlighted on Fab 2 and customer engagement, and the significant potential upside if they succeed. Holding an existing position seems justified by the data provided here.
Okay, what about adding?
If you have a higher tolerance for risk, a genuinely long-term view, and this is crucial if they continue to hit the key milestones outlined in your material, then selectively accumulating shares on price dips could potentially be considered, but only if the positive momentum continues.
In trimming, when would that make sense based on this?
Trimming the position would seem prudent if key milestones get missed, especially anything related to the Fab 2 ramp or customer qualification progress, or if material negative news comes out, manufacturing yield problems, a major customer pulling back, or frankly, if the whole market environment for these kinds of growth stocks just tanks.
Timing is key then. News before year end.
Yeah, the timeline to a potential deal announcement is critical. Any positive news confirming milestones or progress before the end of 2025 would act as an interim de-risker. And again, when or if a deal is announced, the terms have to be substantial. Needs to clearly show a path to significant revenue and profit to really drive a re-rating compared to peers.
Okay, wrapping this deep dive up, what are the absolute critical things for you, the listener, to watch? The key milestones over the next, say, 6 to 18 months to keep track of this story.
All right, key catalysts to monitor based on your sources. Near term, next 6-12 months. Watch the Q2 and Q3 2025 financial results closely. Look for specific updates on Fab 2 ramp progress yields, quality metrics, costs. What's the outcome of those lead smartphone customer qualification deliveries that started in Q2? Need confirmation and details on that planned smartphone launch using their batteries later this year? Monitor the start and ramp up of commercial IoT shipments supposed to begin mid-2025. Any news on the EV partnerships expansion? And critically, confirmation that Fab 2 is ready for mass production in Q4 as planned.
They're looking a bit further out, medium term into 2025, into 2026.
The absolute number one thing is the actual announcement of a major commercial deal. If when that happens, scrutinize the details. Who's the partner? What's the scope? Which products? Volume? What are the financial terms and impact? Then, track the actual financial performance revenue, margins, once shipments start. Does reality match the promise? Look for evidence of them winning more customers or expanding existing deals. That's the next step. And finally, keep an eye on progress with their next-gen tech, EX2M, EX3M. They need to keep innovating to stay ahead long-term.
So summing it all up, Enovix is undeniably at a crucial point, an inflection point. They've got innovative tech, manufacturing is getting ready, and they have real deep engagement with potentially huge customers, especially in consumer electronics.
And the sources you gave us suggest a pretty solid chance that 65-75% range of them landing a significant deal by the end of this year, a deal that could unlock substantial future value. But as the analysis makes crystal clear, the path is littered with significant execution risks. Manufacturing scale-up is hard, OEM qualifications are brutal, and the competition is intense.
Yeah, this deep dive into your sources really hammers home how incredibly complex and frankly fascinating this journey is.
Yeah.
From R&D breakthrough to actually scaling up and selling commercially,
Mm-hmm.
especially in something as cutting edge as advanced batteries.
It really does. Shows how much depends not just on a great idea, but on flawless technical execution, building robust manufacturing, and really savvy customer engagement. All
Yeah.
pieces have to fall into place.
Okay, here's a final provocative thought for you to chew on as you watch this unfold. Given this intense race we've talked about, OEMs, battery companies scrambling to secure next-gen tech, could the type of major deal Enovix eventually lands by year-end? Let's say it's a massive smartphone contract versus maybe an expanded but smaller volume EV partnership. Could that specific outcome tell us more about the immediate priorities and strategies of the entire battery market right now than it does about Enovix's own specific tech or capabilities? Something to think about.
Interesting question. What does the first big win signal about the market's immediate needs?
Exactly. Well, thanks for sharing your sources and letting us take this deep dive with you. We really hope this detailed look helps you navigate the potential and the risks going forward.